Good morning, everybody. I'm delighted to welcome you to Troy's 10th Annual Investment Trust Seminar. I'm actually quite relieved that we're doing it this week rather than last week, as I'm not sure this fine institution was built for 37-degree heat. But thank you all for coming along. So my name is Tom Yowett. I'm Troy's Chief Investment Officer. I've been at Troy since 2014 and have seen firsthand how important investment trusts are to Troy. So today, we manage around $2 billion in investment trust money and are very privileged to be the appointed manager of Personal Assets Trust and STS, and to have the opportunity to grow shareholder investments over the long term. So thank you for your continued trust and support. So the agenda for today is I'll pass over to Charlotte Young and Sebastian Lyon to talk about Personal Assets Trust before James Harries and Tomasz Boniek discuss STS. We'll then leave 10 to 15 minutes for questions at the end. And then please do join us next door for some sandwiches and light refreshments. We have really good representation from Troy and the two investment trust boards, all of whom are very willing to answer any additional questions you may have. Before passing over to Charlotte, I just wanted to say a couple of brief words on the broader investment trust industry. As many of you know, it's been a really tough time for investment trusts over the last few years, characterized by share prices that have been trading at very wide discounts to net asset value on average, record share buybacks as a result, and increasing and very public activist pressure spearheaded by Saba. Against this backdrop, this tricky backdrop, we believe the virtues of having a discount control mechanism are even more pronounced. So, as you can see in the stability and consistency of the dark blue lines on these charts, one of the main advantages of discount control is that it reduces volatility by minimizing the extent to which share prices diverge from underlying net asset value. It also, a well-managed discount control mechanism also greatly helps improve liquidity, ensuring that shareholders can buy and sell as they see fit rather than by appointment only. As importantly, it also discourages activism and the disruption that an opportunistic activist can bring. And in our experience, it's also been a fundamental sort of driver of growth in investment trusts over the very long term. So as many of you know, Personal Assets Trust was very much a pioneer in this field, introducing a discount control mechanism in 1999 and enshrining it in the Articles of Association of the company. STS also has a discount control mechanism which it introduced in 2020 when Troy took over management of the trust. We're also firm believers that independent boards are crucial to the success of investment trusts over the long term. And as you can see on this slide, both Personal Assets Trust and STS have strong independent boards, ably chaired by Ian Ferguson and Sarah Harvey, both of whom are here today. So please do ask any questions you may have of them. Finally, we're delighted to welcome Sharon Brown to the PAP board in July last year. Sharon brings a wealth of experience with her, having formerly been a finance director at Dobby's Garden Centres, and she's currently a non-executive director of Baillie Gifford Japan Trust, as well as Celtic Football Club. I hope there aren't too many Rangers fans in the room. With that, I'm going to pass over to Charlotte. Thank you.
Great. Thanks, Tom. And thank you, everyone, very much for coming. And those of you who are invested in Personal Assets Trusts, thank you as well. So today we're going to do three things. We're going to talk about what it is we're trying to achieve with PAT. We're going to be talking about what's happening in markets, what's driving them, and particularly focusing on AI. And then we're going to talk about what we're doing about it, so what's in the portfolio. And when we think about why people have invested in Personal Assets Trust for the past 43 years, we think about a man called Charles Blondin. He's not a current investor. He was actually the first man ever to walk a high wire tightrope, and he chose to do it in 1859 across Niagara Falls. So for us, we really see this as a balancing act. People come to PAT for two things. They want protection and they want growth, and neither one can come at the expense of the other. If we go too far in one direction, then we're going to fall off the tightrope. And it's worth just recalling the interdependency of those two. So you can see here on the chart, if for any given loss, what the required gain is just to get back to square one. So if you lose 50% of your money, you need to make 100% to get back to the beginning. If you lose 70%, you need to make 233%. So it's better not to lose so much in the first place, and then compounding can resume more quickly. And that has been the lived experience. So here you can see, since the inception of Troy's multi-asset strategy, the red areas are the drawdowns of the market, so the 6 major drawdowns that we've experienced, and the blue areas are the drawdowns of the portfolio. And you can also see the time that it's taken to get back to square one. So for example, in COVID, it took 56 days for the mandate to get back to where it was. It took the UK market 448 days. And since we've run Personal Assets Trust at Troy since 2009, we've annualized at a little over 7%. Over the last 12 months, it's been, relative to the markets, a somewhat disappointing or lackluster, just over 6.5%. And this year to date has been eventful in markets. So in February, we had the SaaSpocalypse, so-called SaaSpocalypse or SaaSmageddon, when the latest AI model essentially came out and upended the valuations of various software as a service businesses, but also companies as diverse as commercial real estate brokers to Thomson Reuters. Then we had the invasion of Iran in March, and most recently we've had the appointment of Kevin Warsh as chairman of the Federal Reserve. And markets haven't really known which way to look. Some sectors are looking into the abyss, whilst others are most decidedly looking to the stars or to Mars, most specifically. And if we were an alien looking down from space, I think we'd be amazed by the fact that the market capitalization today of NVIDIA, which stands a little below $5 trillion, is equal to the market capitalization combined of the bottom 222 companies in the S&P 500. So AI is almost certainly the most remarkable feature of stock markets over the past 3 years. The pace at which the large language models have continued to develop, the commercial use cases for this technology, and the impact that this is having on our lives, on our day-to-day working lives, but also on the economy at large and the stock market. And the real question is, are we in a bubble? And I think the answer is almost certainly yes, but this bubble is still in formation. And just to put a few numbers to that, so 130 times, that is the multiple of sales at which SpaceX, Elon Musk's space exploration firm, came to the market 3 weeks ago. $725 billion, that is the projected amount of capital expenditure that is due to be spent this year by the hyperscalers. And 7.2 times, that is the optically low multiple of earnings on which the memory chip manufacturer SK Hynix currently trades. So it's worth saying first that we are experiencing a generational shift in technology. There is a huge amount of uncertainty. We don't know how much more the models are going to improve. Nobody knows how quickly this is going to be deployed by companies. And we don't know how much they're going to be prepared to pay for it and what is going to be the cost of the technology. So we need to grapple with all of these things. But most importantly, we need to focus on what's in the price. What are valuation multiples telling us in terms of market expectations? And so SpaceX, which delivered $19 billion of revenue last year, is now trading on around $2.2 trillion in terms of market capitalization. And there is no historical precedent for a company this big being this expensive. But we have looked at the multiples of some large cap companies that traded on similar multiples at the height of the dot-com boom. and we looked at what their subsequent one-year share price return was from those valuation peaks. And you can see here with Amazon at 147 times sales, subsequently returned minus 80% over the following 12 months. And Yahoo at 50 times sales, peaking in the first quarter of 2000, subsequently delivered a return of minus 97%. And then at the other end of the spectrum, we do have these companies, these hardware companies, which look quite good value. So the likes of SK Hynix, but also the other two dominant memory chip manufacturers, Samsung and Micron, they have seen their earnings go vertical, and that's the blue line. The red line is their market caps. And essentially, this has happened particularly over the last 12 months as the compute infrastructure spend has accelerated, but particularly that demand for memory has exploded. And we need to be clear that this could continue, probably will continue, but the CapEx cycles are cycles. And if we go back to 2007, the house builders also looked good value. They were trading on 7, 8, 9 times their earnings. We can see their earnings on the right-hand side. That was well supported until it wasn't. And we all know what happened to the share prices on the left. So this is not a perfect parallel, and AI is in its infancy. We know that less than 20% of companies today are starting to deploy AI at scale. So we really need to think about how we should be investing. We need companies that can benefit from this, but which are not reliant on one single outcome. We also need those companies to have a margin of safety in the valuation. We have Alphabet in the portfolio, which we were adding to substantially last year, at a multiple of around 15 times earnings. The share price of Alphabet has since more than doubled, and we're now taking profits. And we also spoke to you last year about Hubble, the manufacturer of grid equipment in the US, which is benefiting from the data center build, but which does not rely on data centers for the fact that the grid will need more investment over the next 10 years. And it's usually in a case of radical uncertainty and huge technological change that the winners are only clear with hindsight. If we think about the search providers of the late 90s, the Yahoos, the Ask Jeeves, they are not the dominant search providers of today. And when you think about the app economy, whether it's Uber or Airbnb, those business models were not even created until almost 10 years later, after the release of the first iPhone in 2007. The philosopher Kwame Appiah said, "In life, the challenge is not so much to figure out how best to play the game. The challenge is to figure out what game you are playing." And if we are preserving capital, we are not in the game of trying to shoot the lights out. We need to seek to avoid the landmines and be just very humble that there will be a lot of value created here, but also value destroyed. And as we think about the winners of today, the stock market leaders, whether it's Nvidia, whether it's Anthropic, we need to really question, are they going to be the winners of tomorrow? And it's worth bearing in mind, it's often the second mouse that gets the cheese. Today, there seems like there's a lot to go around. The SpaceX IPO was 4 times oversubscribed, and retail investors are all in. So if you look at equity trading volumes by retail, for the month of May, that exceeded the previous record, which was made in January 2021, at the peak of the meme stock and GameStop bubble. And this is at odds with what is happening to the cost of capital elsewhere. So if we think about the invasion of Iran, the war that's still going on in Iran to some extent, there's no resolution. We know that this is the 4th inflationary supply shock that we've experienced in the last 6 years. So starting with COVID, moving on to Russia, Ukraine, and then in 2025, tariffs. And we don't know when the strait is going to fully reopen. We don't know whether Iran will prove to be an economically rational negotiator. But we do know that this is the biggest oil supply shock in history, and that these shocks tend to hit equity markets. They tend to also hit inflation with a lag. And US inflation is already above target. So the green line is US CPI, which was sort of bobbing around the 3% level prior to the war breaking out. And we don't know what Kevin Walsh is going to do with interest rates, but we do know that the bond market is likely to respond. If inflation continues, long-dated bonds are unlikely to be a good way to preserve capital. So we are short duration in the portfolio. We have around 30% across UK and US index-linked bonds. And here's just an example of one such bond, which matures next month, actually. But if you'd held that since 2019, over the past 7 years, it's generated a nice inflation-linked return. The reason that the red line, this is the equivalent conventional bond, is so much lower, and those two should be the same if the bond market correctly prices inflation. The reason it is so much lower is that the bond market has consistently underestimated this new inflationary risk, which we think persists today. So we are endeavouring to position the portfolio such that we are protecting against these risks that we perceive, but also so that we can grow in a number of possible futures. And with that, I'll hand over to Sebastian to talk about the portfolio.
Thank you very much, Charlotte. Welcome, everybody, and great to see so many familiar faces. So what are stocks, as Charlotte highlighted? Here we are. Robin Angus used to say that the stock market can tempt an investor as a child is tempted within a sweet shop. There's so many opportunities, so many companies. It's our job as investors to discern between them, to not be tempted. We aim to invest long term. We're not specialists, but we want to endeavor to be selective. And from time to time, we will be, as perhaps we are at the moment, somewhat unfashionable. But we have always had a qualitative North Star, which guides us and hopefully keeps us out of trouble. We endeavor not to overpay, but this can be harder in a not a target-rich environment, which we would argue is the case at the moment. And we should try to endeavor to diversify our portfolio, but not, as Robin used to say, to diversify our portfolio, i.e. adding just names that don't actually achieve that diversification and decreasing the quality of the portfolio. So what do we look for when we look for stocks? Well, high returns on invested capital, perhaps, obviously, sustainable growth, ideally. But most of all, I think the qualities that we look for are durability, that there's the sustainable profitability of a business, and also, perhaps less considered, scarcity. Scarcity matters to an equity investor. For example, a couple of years ago, we invested in VeriSign, not a particularly well-known business, which owns the domain names of .com and .net. So any company that wants to have a domain name of ending in .com or .net has to pay VeriSign for the privilege every year. A very sticky business model indeed. So we steer clear of low return, highly cyclical businesses and those that have a lot of debt. We don't want companies that are mortgaged to the hilt. We don't want companies that have profitability that's unproven or non-existent. And some of those stocks will be flavor of the month from time to time. We've seen it before, whether it be airlines in 2013, house builders in 2006, or unprofitable tech like Peloton and Zoom back in 2021 that Charlotte alluded to, the meme stock bubble. We also want to avoid lobster pots, and by which, and Tom referred to this a little bit earlier, stocks that can be easily entered but exited by appointment only. That reduces all flexibility that we have. It's very important for you. Tom mentioned the buyback and issuance. We want to have a liquid portfolio, and we could liquidate the portfolio virtually in its entirety within a week or so. But we also want to avoid moonshots. Now, when we first put this slide together a few years ago, we really were referring to big gambles that were highly unlikely to pay off. We didn't actually mean it literally. But here we are in the age of SpaceX, the ultimate moonshot. And as Charlotte, to echo Charlotte's views, when it comes to personal assets, we are not going to chase pots of gold at the end of rainbows. So what are we investing in? And don't all yawn. We are investing in quality businesses, not just defined by quality growth, which is a rather nebulous phrase at the best of times, but in a world of higher bond yields and stickier inflation, we at Troy have been widening our aperture for companies that have different qualities and benefit from this new economic environment that we're in. Firstly, about 2 or 3 years ago, we invested in Canadian National, the railroad, a very good example of scarcity, an irreplaceable railroad, obviously built in the 1860s. We're now seeing another railroad type boom, but clearly this is an asset which is irreplaceable or highly scarce anyway, and beneficiary from the increasing CapEx cycle, and a very effective, cost-effective method of transporting freight across North America, far more than trucking. In grid infrastructure, we invested, and I think we talked about this last year, in Hubble, which makes essential parts for the grid in the US. The grid has been underinvested in for decades and requires additional capacity, also as a marginal beneficiary from AI-related investment as well. But this is essential spending and unavoidable spending as well. And then finally, in insurance, where we've always actually had some exposure within our portfolios for most of the time. Recently, about 3 years ago, we acquired a holding in Chubb, and most recently in Markel. And insurance is an example, I would argue, of good diversification. It's an industry that sings to a different tune than both the equity market and more generally economic cycles. So turning to Markel, and I know there's a very experienced insurance investor in the audience, so I might refer to him for Q&A. But Markel, not a very well-known company, although it's sizable, $24 billion of market capitalization. It is a very good example of a patient compounder. Not very well covered by analysts, which we actually view as a positive. Markel is a sort of mini Berkshire Hathaway. Effectively uses what's known as its insurance float, i.e. the premiums which it's paid every year to invest and compound in public and private companies. I first met the company back in 2013, and we've met the management a couple of times over the last year. Markel has a sort of distinctive personality. It's family rooted, having started back in 1930, has long had a family member on the board. In fact, Steve Markel has been on the board since 1978 when I was in shorts. So quite a bit of longevity there. With disciplined capital allocation, it is trusted, it has a trusted and long-standing leader, Tom Gaynor, who at 63 is a young man compared to Warren Buffett. And we believe we had a compelling entry point a month or so ago in Markel, buying the shares at a mere 1.1 times book value. So I think a classic personal assets trust investment from the perspective that it has good asymmetric risk. We think it's got relatively good downside protection, but good positive upside potential. Now, when talking of scarcity, nothing is more scarce than gold as an asset. And yes, an unusual holding for an investment trust, but we've held it for perhaps since 2009. And again, it's been a good diversifier for shareholders. We've had a meaningful amount, plus or minus 10%, going back then. Now, since the invasion of Ukraine in 2022 and the confiscation of Russia's reserves and their exclusion from SWIFT, the international payments, a payment system, central banks around the world have been buying gold. In fact, their reserves have increased above the level of US treasuries in the past year, and gold reserves for central banks are now at a 50-year high and continue to grow. The debasement of paper currencies, which we've talked about probably ad nauseum at meetings like this, continues and shows no signs of abating. Government debt to GDP continues to rise in the West and looks increasingly unsustainable. However, the gold price surged over the past year. This time last year, when we were speaking, the gold price was $3,300 an ounce, and at its peak in January, it reached intraday about $5,500 an ounce. At the end of January, Charlotte and I made the perhaps radical step of reducing Pat's holding at around the $5,100 level, from 14% down to just below 10%. Or put another way, we sold 43 bars of our 158 bars that we had at JP Morgan in our vault, which the board and the auditors and us as managers occasionally visit and stroke. Now, this sale may sound sacrilegious to some. It might sound like sensible risk management to others. We would probably err on the side of the latter. And despite the falls to $4,000 an ounce as at last night's close, we are still long-term bullish of gold. We may well add to it on some continued weakness. But we just felt, both of us agreed that it just ran far too far and too fast. So we took some money off the table. What of the risk of diversification? We also look for portfolio offsets. And in the past, in terms of currencies, we've held exposure to dollars, we've held exposure to Singapore dollars, we've held Swiss francs, and others. Last year, both of us became increasingly concerned that the dollar was going to become less reliable with tariffs and with, obviously, as I mentioned earlier, the concerns over the US dollar vis-a-vis SWIFT and Russian sanctions. So it was, having been an incredibly reliable boyfriend, it was becoming a little bit less reliable. When markets went down, the dollar tended to go up and vice versa. So it was extremely helpful from the portfolio's perspective. And so I think we discussed this last year, but we bought a relatively modest holding, part of our liquidity of about 9% into yen, which hasn't done us any favors, although it hasn't done us any harm either. We view it very much as that asymmetric risk of when things really melt down, it's likely that the yen will go up. And that's really a function of, partly a function of the carry trade, which effectively investors borrow money in yen because interest rates are low in Japan, and they invest elsewhere. So when those investments do poorly, they suddenly have to become forced buyers in yen. And you can see that this is effectively what happened back in 2008. So you can see on the left-hand side there, the extreme appreciation against sterling during the financial crisis of 100% of the yen compared to the dollar at 47%. And also you can see gold there. Sorry, I beg your pardon. The yen is 82% compared to gold at 100% and the dollar at 47%. And see the depreciation of the stock markets on the left-hand side. Now, the other thing to point out is the yen is unambiguously cheap. It's been actually expensive for most of my career. But you can see, on the right-hand side, you can see PPP, which is purchasing power parity of the yen, which is in red, and the Japanese yen and US dollar level in blue. And it's about 40% undervalued. And I can vouch for that because Stephen Budge, who is at Juniper and day-to-day manages our discount control mechanism, as a canny Scot, went on holiday to Japan only 2 weeks ago rather than following the Tartan army to Boston. So the yen is cheap. We think there's good asymmetric risk there. It's liquidity, but we think when things get more difficult, as and when things get more difficult, the yen will actually protect us pretty well, and we can use that as a source of liquidity for increasing our equity exposure. So where are we today? We're pretty conservatively positioned. Charlotte alluded to, we've got our equities at 36%, which we would hope to increase. A year ago, they were in the 40s, so Charlotte alluded we were taking gains in things like Alphabet over the last year. Inflation-linked bonds, which we still view very much at the core within the portfolio at 30%, both US and UK, and we've been increasing the UK exposure. Gold at just over 9%, and then our liquidity, including that yen exposure, at 25%. So to conclude, We don't think this is a particularly target-rich environment, but that can change very quickly. On the contrary, we think that there is material investor complacency, and there are reasons to be fearful rather than greedy. And I think the SpaceX IPO is a microcosm of that greed. In fact, it feels like a microcosm of the dot-com bubble all rattled into one stock. So it feels dangerous to pick winners, but also difficult in terms of avoiding losers, especially with the heightened geopolitical risk and index concentration, value-insensitive momentum investing as well. Robin Angus always used to like to quote this, use this Lewis Carroll quote, that occasionally investors want to believe 6 impossible things before breakfast. And it certainly feels like we're back there today. And this year, sadly, we lost Robin's professional other half and long-standing chairman of Personal Assets, Hamish Buchan. Hamish was a larger-than-life character with an eye to detail and an amazing enthusiasm for investing. It was he who said that investing in investment trusts was the most fun you could have with your clothes on. I'll leave you to decide whether you agree with that. Hamish was always kind, supportive, happy to tweak charts at the last minute on presentations. In fact, my most memorable AGM with Hamish was him giving the introduction, taking all of the votes, handing over to me, closing my laptop, then to find that all the slides went down and technicians ran around for 10 minutes trying to get me back online before I could give my presentation. But we will miss him greatly. Back in 2000, my predecessor, Ian Rushbrook, said that, to me, investing in the new economy is a flight to the Never Never Land or bungee jumping without a rope. And we won't be doing that anytime soon. And with that, I'll hand over to James.
Okay, thanks very much, everybody. My name is James Harries. I'm the co-manager of STS, Global Income and Growth Fund, along with Tomasz Boniek. I'm going to begin by talking once more a little bit more about AI. Sorry, I won't bore you, but we'll talk about it a bit more from a stock market perspective, a bit more about how also the world is changing quite profoundly at the moment, in our view, and that should give us longer term lots of opportunities. And then finally, about the portfolio itself. I did think it might be worth just reminding us about the history of Troy. Troy was obviously started by Sebastian and Lord Weinstock a long time ago, but it was started at one particular time. And this is the share price of Lord Weinstock's company. And I guess it's worth reminding ourselves that it went up a lot before it came down a lot. And that's the sort of environment in which Troy was created. And in a sense, that's what we are for as a company. And so I'm not saying that the current backdrop is exactly the same as the TMT boom, which is what we're showing here. But it is a reminder that cycles can go up a lot and then come down a lot, and it shouldn't be any surprise to people. And related to that, you can see that our performance recently simply hasn't been good enough. And I apologize to the board, and I apologize to our investors. It's frustrating in a sense because we were in touch till really quite recently. But in the last few months, a bit more than that, an alligator's jaws has opened up, if you like, where effectively those who've embraced the current boom have done much better than we have. It's painful, but we would like to talk, or spend a few minutes talking about why we think that may not last and what we're going to do about it. So this is another great piece of data mining from Bank of America, which is showing previous booms going back through history. And these are the really big ones. So the railroads, which I'm sure you've all read about, the Nifty 50, TMT, Japan, that really was a big one. And you can see in terms of concentration of stock markets that what we're currently seeing in AI is every bit as significant as some of those truly historic booms. Now, that is pretty remarkable in lots of respects. And as Charlotte mentioned, this is having a profound effect in lots of different ways. It's a profound effect in terms of the returns that are being generated in stock markets. It's having a profound effect in terms of economic activity. Without the AI capex boom, you could argue that economic activity would be rather lackluster. Indeed, it did look awfully like, as a result of interest rates rising in 2022, we were moving into a big slowdown, and this was kind of interrupted, if you like, by the AI CapEx boom. But don't forget that this is a very important part of what's going on. And as Charlotte mentioned, the thing about CapEx cycles is they are a cycle. The second way, and the third way is, of course, through consumption. That those who own stocks, which tend to be in the upper echelon of socioeconomic groups, are feeling pretty happy at the moment and are spending, but others are feeling it finding it much more difficult. And that is being described in a K-shaped economy. So if we accept that at some point a cycle has to come to an end, where do we think we are? Well, you'd have to say there are some signals that we're towards the latter part of what has already been a historic cycle. First of all, the concentration that you're seeing. Secondly, the IPOs that Charlotte was already mentioned, SpaceX and coming is going to be Anthropic, OpenAI, and so on. Now, it so happens, as I'm sure you all know, that IPOs tend to be done at what are called by bankers favorable market conditions. That tends to be favorable for the seller, but not necessarily favorable for the buyer. And so if we look back in history, particular companies floated at the zenith of a particular trend, which was reaching its highest point when they decided to allow others to share in the good fortune that they had enjoyed up until that point. So an example would be Goldman Sachs. Good old Goldman Sachs. When did it float? 1999, right at the top. It had been a private company, a partnership, for many, many, many decades. But they decided that that was the time when they were going to allow others to, as I say, share in their good fortune. Blackstone, very large private equity company, floated in, guess what? 2007, just before the global financial crisis. They, again, probably recognized that the trends which they had benefited from were reaching some form of peak. And then Glencore, 2011. Basically, we'd had this enormous commodity boom driven by the build-out of the Chinese economy, which once again reached its peak in 2011. So when you have these very large companies that represent a particular cycle coming to market, they can often mark the peak. Now, there's a legendary strategist called Bob Farrell from Merrill Lynch, because I think at these times it's important to have a bit of longevity and a bit of perspective. And I'm not going to read those all out, but there are three that are particularly relevant, I think. Number 3, there are no new eras. Excesses are never permanent. Number 4, exponential, rapidly rising or falling markets usually go further than you think, but they do not correct by going sideways. And number 7, markets are strongest when they are broad and weakest when they are narrow to a handful of blue chip names. Now, that was written a long time ago, but it could have been written yesterday. And we're reminded, I hope you all can read that, yes, that before bubbles, it tends to be certain winners, but post-bubbles, they change rapidly. And this is because if you're deploying capital on a premise that turns out to be a bit over-optimistic, that can cause real problems for your business, but it can also cause, if at scale, real problems for the economy more broadly and in terms of economic activity and employment. And so you tend to get a radical change in leadership. And we would expect that to happen again, the timing of which, of course, is uncertain. But it's also making the point not only would leadership probably change to some businesses which are currently left behind, but also that, as Charlotte mentioned, the winners over the next 10 or 20 years, we probably don't even know who they are yet. In fact, the likelihood is we haven't heard of them. And if we have, they may well go down quite a lot before they then recover, akin to Amazon. So while all of this is going on, while we're all transfixed by AI, there is also the greater structural change taking place, that we are in a brave new world. I have been calling this a reverse Berlin Wall, but it's a bit obtuse. What we're saying is that the backdrop over the next 10 or 20 years is likely to be very different to what we've been used to over the last really 40 years. Because when the Berlin Wall came down, it set up a whole chain of events. Bond yields peaked, inflation peaked. It was a relatively peaceful world, potentially outside the Middle East, although there always seems to be problems there. Eastern Europe came on stream, which we had a big pool of cheap capital. And that enabled companies to optimize their cost base and countries, importantly, to optimize their comparative advantage. Now, because today, most of those things don't hold anymore. We're balkanizing into a US and a Chinese sphere of influence. Inflation is back. Bond yields are corrected to the upside, but arguably equities have yet to. And this is going to have pretty profound implications for ongoing globalization, for rebuilding of strategic supply chains, for reestablishing strategic autonomy in the developed world, in capital allocation, and so on. And to the patient investor who is aware of that and observes that, that should provide opportunity. So we, as Sebastian mentioned, we at Troy are somewhat widening the scope, if you like, of the sorts of businesses that we would buy in terms of geography and in terms of business model. Now, what we are not doing is dropping our quality filter, but we are seeking to diversify the portfolio somewhat to capture some of these changes and trends which we are talking about. And it's interesting to us that as the market is rising and becoming more concentrated, we think some really excellent assets are being thrown by the wayside by the market, which is enabling us to pick up high-quality assets with pretty fast-growing free cash flow and therefore income for the portfolio. We're showing 4 of them here. Novo Nordisk, controversial perhaps, but still a very good business, very out of favor, and very good value. Eventim and Vinci, which Tomasz will now talk about, and AIA, which is a Chinese insurer. Effectively, at one level, the investment case for AIA is quite complicated. Another, it's quite straightforward. In a company like China and Asia more broadly, one of the things you do as you gain enough wealth to be considered, if you like, a middle-class person, is to insure yourself. And the level of insurance in those economies is still structurally dramatically less than it is in other parts of the world. So I'm going to hand over to Tomasz, who's going to talk to you about a couple of businesses that we've bought.
Thank you, James. Now, before I start, James gave us a great overview of why valuations matter. He introduced the notion of the Brave New World. I'm not sure if you've done it on purpose, but room went all dark. Not sure this is what we necessarily want to talk about. What I wanted to do is to take that macro view and take it down to the company level, because ultimately what we're trying to do is find good companies with good competitive positions that can grow the cash flows over time. So the first company I wanted to introduce is CTS Eventim. CTS Eventim is the leading ticketing platform in Europe for live music and entertainment. In other words, if you attend a concert in Europe and partially in the UK, chances are that your ticket will be sold by CTS Eventim. Now, CTS Eventim has 2 legs to its business. The first one is the ticketing business, which I'll come on to later. And the second one is the organization, promotion, and operation of venues that host these live concerts and entertainment shows. The ticketing business is particularly valuable to us. This is a business that benefits from scale and has strong network effects. What I mean by that is if you're in Germany or Italian, I'm Italian, so I'm very familiar with CTS Eventim business, you will go to ticket1.it to look for shows and music venues, and that's the only place where you will go to buy tickets. And the reason is that all the best shows are advertised on that platform. That attracts traffic, and traffic in turn attracts more venues and more shows. And you can see how the business model works. And this is a business model that lends itself to concentration and market domination. And that is why CTS Eventim in its core markets, Germany and Italy, has more than 80% market share, 80. This is not the only reason why we like the business. We also like that it's exposed to an increasing trend of consumers want to create memories rather than buying stuff. We want to create memories with friends and family, and increasingly we're doing so by going to live events. Could be a concert, could be Wimbledon the next 2 weeks, or horse racing. But the idea is that consumers increasingly want to spend money on experiences. The next business is Vinci, which perhaps is a good introduction to the type of businesses that we can consider and we will invest in when we spoke about widening our aperture to sort of realize opportunities in this brave new world. Vinci is a French company that owns and operates essential infrastructure, and they also have a more cyclical business in construction and contracting. Now, when I talk about essential infrastructure, Vinci manages motorways and airports. To bring the business to life, in the UK, they own 3 airports, London Gatwick, Edinburgh, and Belfast. They haven't got to Wales yet, although with all this talk with number 10 North, I'm not sure Wales will be priority anytime soon. These infrastructure assets are great. They have contracted cash flows. They're obviously protected from competition. They often are natural monopolies. And their cash flows tend to be linked to inflation. Vinci actually discloses that around 70%, 70 of their cash flows are inflation linked. We like this exposure, but Vinci is not just an infrastructure-like company. They also have a more cyclical construction and contracting business, which is where the opportunity lies. The combination of these two businesses is really fundamental and valuable. You have stability on the one side, but you have growth opportunities on the other side. To go back to what James, Sebastian, and Charlotte were talking about, we need to invest, Europe badly needs to invest in energy security, the energy infrastructure. They need to build stuff. And Vinci is a business that is greatly positioned to benefit from these trends. So to bring the two businesses together, CTS, Eventim, and Vinci, very different businesses. One helps people forming life experiences. The other helps economies operate smoothly by running essential infrastructure. But they share commonalities. They're good businesses. They have good competitive positions. They have long runway for growth. And we bought them at sensible valuation. So whilst the world might be changing, our discipline is definitely not changing. So with that, James, I think you have some concluding remarks.
Thank you, Tomasz. So the effect of this is that we have a lot of value in our portfolio. What we're showing here is some of our holdings relative to their 10-year median valuation. And across the board, we have some very compelling valuations in many of the companies in our portfolio. And the best way to demonstrate this is the relative free cash flow yield of the portfolio relative to the market. And it's better value than it's been at any point since I've been at Troy. So, and the underlying growth of income in the portfolio is accelerating. You may recall that we had a step up in the dividend a couple of years ago to slightly tweak the returns from the trust towards income as well as capital growth. And you can see that in the dividend distributions here. But it is also the case, importantly, that the businesses that we're buying, like the two that Tomasz was mentioning, are not only good value, but they're growing more quickly than the businesses that we're selling. And therefore, the underlying income growth of the portfolio, while the value is improving, is also accelerating. And we think that that combination of value and accelerating underlying free cash flow and dividend growth at a time when markets are so concentrated and so fully valued, in time, should serve investors well, despite the recent underperformances, as I mentioned. So what we're trying to show here, and I'm not sure if it quite works, this is us plowing our own furrow. While Elon Musk is talking about mining asteroids, and we're about to have the fireworks of OpenAI and Anthropic. But we think if we stick to the course and we continue to try and build in high-quality, growing businesses that we think are out of favor, but represent both excellent competitive positions and excellent valuations, then at some point, people may start concentrating a bit less on the stars and a bit more about what happens here on Earth. Thanks very much indeed.